Quite a number of people try to game the financial markets in a bid to make short-term gains. However, they go about it the wrong way and very often end up losing money. How then do you invest and actually make money? Now, this is a question a lot of people ask, so today I will share with you some recommendations on how to make the best investment decisions that would benefit you in the long term. Hi, my name is Darius Muika. I'm a senior investment advisor with Noor Private Wealth. If you are new to my channel, I focus on helping clients build wealth in the most tax-efficient way possible. So let's jump right in. In no particular order, I would talk about different strategies and tips to consider if you want your investments to perform better. The first strategy to adopt if you want to make money from investing is to avoid overtrading. A common investment mistake many people make that may cost them money in the long run is selling off their investments at the wrong time. Some investors are highly driven by sentiments and concerns on market volatility, and as a result are quick to sell off their investments. While financial markets are indeed volatile, short-term volatility may not be a good reason to sell off your investments, at least not yet. If you're wondering why, I'll tell you. The probability of the market going up on one single day is 52%. Now, this percentage is even higher for a longer period. Going back all the way to the Great Depression, the probability of the market going up in one single year is 68%. If you extend that period 14 consecutive years, the probability increases to 100% and the average return over that period is 191%. Making short-term decisions can impact the long-term outcome on your investments. For example, due to the uncertainties caused by the elections, a lot of investors stayed out of the market due to fears of losing money. However, in no time, the markets rallied close to 10%, causing them to miss out on this 10% hike. In investing, every short-term gain is relevant to your returns in the long term. So if you are wondering how best to manage your investment portfolio, the best way is to stay in the market for the long term. Investing long term may yield higher returns when the market eventually rebounds. The second investing recommendation is to avoid holding on to the losers while selling off the winners to make short-term gains. Too many investors are quick to sell their winner stocks in order to capitalize the gains, leaving behind only loser stocks in their portfolio. Peter Lynch, one of the most successful portfolio managers in history, likened this behavior to cutting the flowers and watering the weeds. Some market speculators believe that well-performing stocks may have indeed reached their peak and would begin to fall. However, this may not be true, especially if there are no supporting financial fundamentals of the underlying company that indicate a drop in stock price. Avoid selling off your winners as you may miss out on better long-term gains. A good quality investment may go down with the market during downturns but will always rebound. The third investment tip that would help you make money in the financial market is to view market volatility as an opportunity rather than as a risk. As stated earlier, knowing the best time to buy into the market is very important. Market volatility creates an opportunity to buy into company stocks that you have always wanted to invest in but stayed off because of a high price. Every time volatility increases, some stocks get beaten down during sell-offs, and this will create an opportunity to add them to your portfolios at a lower level. When the market is volatile and stock prices dip, it may be a good time to go shop around and get good deals, and as you would have often heard, this may be the best time to buy low. This way, you get a good stock for a lower price, giving you more value in the future when the market rebounds. I mean, you wouldn't think twice if you saw your favorite item 50% off. On to the next and fourth strategy. If you want to invest and make money, you need to diversify your investments across industry sectors and also invest internationally. The Canadian stock market lacks breadth and is limited in terms of stock selection. The top three industries in Canada are the financial industry, the energy industry, and materials industry. Together, they make up 72% of the total Canadian market. If you have significant exposure to the Canadian market, it is very likely that you have also significant exposure to these sectors. Many investors have a bias towards Canadian stocks, and thus their portfolio coverage is limited to Canadian industries. This bias may be linked to the time when the RRSP did not provide tax benefits for investments outside of Canada. Even after this changed in 2005, many Canadian investors are yet to diversify and take advantage of different international sectors such as IT, healthcare, consumer discretionary, and consumer staples, amongst others. These sectors are virtually non-existent in the Canadian market and just might be the most important sectors in the entire stock market universe. Restricting your investments to the Canadian stocks may cause you to lose out on gains in the international markets and industries not represented in the Canadian market. My fifth investment tip is to not overallocate the investments in your portfolio to bonds. Now, a few exceptions may arise, such as if you are a senior or expecting to retire in 3 to 5 years, or if for any reason you expect to withdraw money from your portfolio in the short term. The average portfolio in Canada is made up of 60% equity and 40% bonds. While this portfolio allocation might have worked great for you in the 90s, times have changed. Bonds do not have high yields as they did historically. For example, the historical yield for the 10-year US government bond in the 80s was 15% at some point. This later dropped to 7.5% in the 90s and currently at 0.88%. Technically, when yields rise, bond prices fall and vice versa. With the current market rates, there is only one apparent direction to go. When you add the fees, taxes, and inflation, not much is left in returns for bonds. If you are wondering what the best course of action should be, this would involve adding alternative investments to your portfolio. I talked more about this in the private investments video. If you want to check it out, click on the link above. The final investment recommendation is to consider the secular growth or decline in the industry sectors and markets when making investment decisions. This is one reason why you may be biased and want your children to learn Mandarin instead of Latin, for example. No hard feelings involved, you just want your kids to be better positioned for great market and economic opportunities. Also, for the automobile experts, you would know that the Tesla's drivetrain only has about 17 moving parts compared to the 200 or so in a typical car. Given the shift in the makeup of automobiles, you wouldn't push for your kids to become mechanically inclined, but you would encourage them to go the software and computer programmer route instead. The same principles apply to investing. You want to invest in companies and businesses that are constantly growing their number of customers or the services they offer. A business that has a declining customer base will have declining revenues and the stock price will follow. The production of paper-written checks is in a secular decline ever since digital banking and the e-transfers were introduced. Remember Radio Shack? What about Blockbuster? Brick and mortar retail, the oil industry, and linear TV are also experiencing a similar declining trend. Business and industry trends are important factors to monitor to ensure that you are making the right investment decisions that would enable you to make money in the financial market. In conclusion, you can make money through investments if you focus on the long term, are disciplined, and diversify accordingly. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.